All right, again, everyone, welcome to today's line of credit webinar. We're going to talk about business lines of credit, and I will kick off the presentation with a high-level overview of what a business line of credit is, kind of a little bit about how it works, and then my head of capital markets, Thomas Black, will kind of follow up with me on, what a good borrower looks like, what types of use cases we've been able to provide for previous clients, and then we'll close out with the Q&A at the end. So what is a business line of credit? Well, a line of credit is basically a loan facility that your borrower has access to, but is able to make incremental requests or draws on an as-need basis. It differs a little bit from a loan in that, they're not going to receive a lump sum deposit to their business checking account and start paying interest immediately on that. They can actually draw from it as they need. So as an example, a borrower may be approved for $100,000 in the form of a line of credit. But after closing, they may only need to access $30,000 from that. So the $30,000 is dispersed to the borrower, and then the remaining $70,000 of that $100,000 is still available for them to access at a later date. So like I mentioned, it's a little bit different than a loan. It's more versatile. And there's some characteristics that make it really appealable for certain types of customers. One of those are revolving aspects of it. So revolving meaning that as a borrower continues to pay down the balance, so let's say they made that $30,000 draw, and then they pay it down to $15,000. Well, now there's $85,000 available to them, right? So they can use it, pay it down, use it again, pay it down again. So that's a special characteristic of a line of credit. Also, they're only going to pay interest on that draw balance. So if they're borrowing, drawing $30,000 from the $100,000 facility, they're only paying $30,000 or interest on the $30,000, as opposed to a loan where if they took a $100,000 loan, they're paying interest on that full principal throughout the course of the loan. So that's a great differentiator with a line of credit versus a loan. Also, there are no prepayment penalties with our line of credit programs. Our line of credit programs allow you to be flexible if you have a short-term need for capital, and you don't necessarily, need to be paying something out over the course of 5 years. If it's got a fast turnaround time, line of credit is going to be the best solution for them. There's a multitude of ways or scenarios when to use a business line of credit. And I'll go through a few of them, but honestly, it's my personal opinion and professional opinion that pretty much every business should have a line of credit on hand for use. Why they would get it is for working capital needs, right? Maybe it's anything to do with sustaining or expanding their operations. Maybe they have recurring costs that come up, and they need the ability to draw from a line of credit or source of capital and then pay it off quickly if that time comes. Or maybe there's just a short-term expense that comes up, right? It's something that they didn't anticipate, or maybe they knew that it was going to come up, and they just need that little bit of padding to make that expense, not detrimental to their business. Also, cash flow bridging. A lot of our clients or our partners' clients deal with vendors who pay in invoices, or they pay in purchase orders or something like that. And sometimes those orders and those payments end up being a little bit late. So if there's a cash flow intensive business or maybe a seasonal business, lines of credit are a great way for them to kind of mitigate that as a risk to the business owner. Financing inventory is another great way to use business lines of credit. We're coming up here on the holiday season. We're pretty much in it already. But there's going to be business owners who are looking to expand their inventory because, again, they're seasonal and they anticipate a spike in demand for their product. This is a great way for them to finance the cost of purchasing the inventory they need to make that ROI and get a good return on that investment and meet the demand of their customers and ultimately grow their business and make more revenue. Emergency fund. To me, this is probably one of the number one reasons to have a line of credit. Again, like I mentioned earlier, you're only paying interest on the amount of capital that you've drawn. So you can use this as a way to have access to capital over the long term without having to pay interest on money that you're not using, as opposed to a loan or other sorts of financing methods. Finally, debt consolidation is a great way to use a business line of credit. We have borrowers who were forced into taking out a higher interest short-term or MCA or business loan, something like that. And then they come back and they figure out that, hey, if I had a line of credit, I could, number one, consolidate that debt, and number two, avoid having to take out those types of loans in the future. So let's talk about strategic goals real quick. Again, these are going to coincide greatly with the use cases. Number one, access to reserve capital. It's capital that you have access to, but you're not necessarily obligated to use or pay interest on now. Number two, flexible usage. I mean, those are a multitude of use cases, and I've heard probably hundreds of other ones. So it's very flexible, and typically they get to choose kind of the structure of the line of credit that would work best for their business. And then finally, it's highly cost effective. As I mentioned, there's no prepayment penalties. There's also options for them to take a shorter term use of capital and turn it around quickly, pay it back, and then boom, once that draw balance goes down, they're not paying interest on the capital anymore. So I'll turn it over to my head of capital markets, Thomas Black, real quick to kind of take a deeper dive into the criteria and use cases of a line of credit.
Awesome. Thanks, Craig. So like Craig mentioned, my name is Thomas Black. I'm the head of capital markets here at Loanspark. One of my primary responsibilities with the company is to assess your customers' requests as they come in the door and determine which of our programs, in this case, which of our line of credit programs, is going to be the best fit for their business needs. So before we get into how these loans work, what terms and everything look like, I kind of want to start by covering the types of borrowers that we're looking for in terms of who's going to be a fit for this program. So for the sake of simplicity, we've broken it into two different buckets here, as you see on your screen. So first, we've got required criteria, which essentially means at the bare minimum, they need to meet these characteristics in order to qualify for any of our programs. And the second bucket is going to be preferred criteria, which essentially means if they meet these criteria, they will qualify for the widest variety of options that our marketplace has to offer. So in the required criteria bucket, we've got a year in business, 600 FICO, and $10,000 a month in revenue. Now, on the topic of time in business and monthly revenues, there may be a little bit of flexibility here. Truthfully, I think we can fund a line of credit as long as annual revenues are 100,000 or higher. So that puts you more around $8,000 a month. And similarly, if they've only been in business 9 months, but they have great monthly revenues and solid FICO, we may be able to help out there. But in general, think of this as kind of the low watermark of what we want to see in order to qualify your customers for a line of credit program. On the preferred criteria, we've got 2 years in business, 650 FICO, and $25,000 a month in revenue. So customers who have these characteristics across the board and are borrowing in the name of their corporation or LLC are going to qualify for the widest variety of options in our marketplace. Now, I would like to kind of point out that in order to qualify for the most competitive rates and terms, we even have a third bucket, which I would call 3 years in business, 700 FICO, 35,000 in revenue, and a profile like that is going to qualify for the most competitive terms that we have to offer. But if your customer doesn't meet that, it's no problem at all. We can certainly have a variety of offers for them. All right, so now let's talk a little bit about how we determine pricing and terms. So for those of you who attended last week's webinar on short-term business loans, you'll notice some overlaying characteristics here. But there's 3 kind of main factors that we're looking at, and another 2 which we would consider highly important. So to start with the top 3, that's going to be how long they've been in business, how much revenue they're generating, and the FICO of the main borrower or guarantor. So the higher these numbers, meaning the longer they've been in business, the more money they're generating, and the higher the borrower's credit score, the less risky we view lending them money, and ultimately the better the terms, the lower the rate, the higher the dollar amount that they get approved for. Then we have a couple other factors that come into play. So for much larger requests, we may want to see their business credit score, especially if they've been in business for a while and they're asking for $400,000. We may want to see their business's historical ability to repay debt outside of their personal credit history. And another factor is industry. So similar to the way we covered it last week, we kind of have two buckets within industry. So we've got restricted industries. We can fund these programs in most industries, but things like adult entertainment are just going to be a no-go right from the start. And then we've got what we consider higher risk industries. So construction and trucking are two of the best examples in this space. So if you have a customer who's in the trucking business, those preferred criteria from the previous slide may be a little bit higher for someone in that industry. So we may require, for example, 5 years in business, $50,000 a month in revenue, and maybe a 720 FICO, for example, right? So we have your restricted industries and your high risk industries. These are going to affect approvals. And then we've got some auxiliary factors on the right, which essentially are derived from bank statement information, right? So their average daily balance, making sure that they maintain a positive daily balance. Similarly, having no negative days or non-sufficient funds, making sure that they don't often overdraft their business checking account is going to be something we look out for. And finally, the composition of their deposits. So like we talked about last week, a customer that has $20,000 a month across 20 deposits is considered less risky and volatile than a customer that has one deposit a month that makes up their entire portion of their revenue. Right. So these are all the factors we're going to look at to come up with how much money we can lend, what the rate looks like, what the term length looks like. All right, so what's best case terms for your borrower in today's market? Well, we have term lengths on these products ranging anywhere from 6 up to 36 months. I would say most businesses qualify in the 18 to 24 month window. I would say that's the most common, but for highly qualified applicants, we can issue term lengths up to 3 years or 36 months. Similarly, for these A-plus borrowers, we're looking at interest rates as low as 10% annualized. Now, I'd like to emphasize this is not really an APR so much as it is an annual interest rate, which is going to determine their interest payments. So an APR traditionally is going to include more fees and everything like that. We do have options that don't have fees. So just want to kind of point out that distinction. So 10% for A-plus borrowers is kind of what we're looking at. And then as far as payment frequency, most of these products have monthly payments, and that's what I would say the upper 50th percentile of borrowers are going to qualify for. But in the cases that they're considered maybe a little more risky, maybe their time in business is a little bit lower, or their industry is considered a little more risky, they may be asked to, or they may be offered a product that has weekly or biweekly payments. So again, monthly is kind of what we're targeting, but we may be able to produce an offer that has weekly or biweekly as well. All right, so now I want to walk through an example of what an approval might look like and how to determine the customer's payment, how they draw the money, and essentially how the product itself works. So for the sake of this example, I've given some kind of simple to understand numbers. So this customer has been approved for $100,000 at a 10% annual interest rate. They're going to be making monthly P&I payments across a 24-month term. So the first thing you'll notice here is the monthly P plus I payments. Now, some of you may be familiar with interest-only lines of credit that, say, a traditional lending institution would offer. This product is not quite that. So one of the things we really like about this product is it's very flexible in its use case, but when the customer does take a draw, the draw is essentially, each draw is essentially set up like a small term loan in and of itself. So what do I mean by that? So let's say the customer, the loan is funded, loan's been approved, and now they have $100,000 sitting there waiting for them to take a draw. Most of these programs, they will go into an online portal and select the amount of money on a sliding scale that they're looking to withdraw, okay? So in this example, let's say it's $20,000. So we know the 10% rate. Most of these programs use a 30-day billing period. So we want to calculate two numbers from this, right? It's going to be their monthly interest payments and then their monthly principal payments. So like I said, I mean, they take the $20,000 and it's set up on essentially a small term loan. That term length generally defaults to the term that was part of the initial offer. So in this case, 24 months. So each draw they take is essentially, when they take the money, it's going to be set on a 24-month payback period. So where you see principal payment, you're taking your $20,000, dividing it by 24 payments, and $833.33 is what they're going to be paying back of the principal each month. Then to calculate the interest, which is based on a 30-day billing period, you're essentially going to take your draw amount, multiply it by their rate, multiply it by 30 days because of the 30-day billing cycle, and divide by 365 days. So this gives you your monthly interest payment. You add the two together, and this is the total monthly payment you're making for this singular draw. Now, the difference is that the customer is making this payment only on this first draw, and they have access to the rest of the capital at any time they need it. So when we go to the next slide, and you might be wondering what happens if they want to draw money a second time, well, essentially the same thing's going to happen, and their monthly payment's now going to be the aggregate of the first two draws. So in example number 2, I won't walk through the whole thing again, but $10,000 draw, right, which is half of 20. So you're going to have half of the monthly interest payments using the same formula, $82.19. You've got half of the principal payments. Since 10,000 is the half of the 20, you've got $416, and the total payment on that second draw is $498.86. So now that the customer has taken a total of $30,000 worth of draws, as long as they're holding onto that money and not repaying the balance in full, we're looking at a total monthly payment of $1,496.57. Now, one of the nice things about this product is no prepayment penalties. So if the customer is looking to pay this off in full at any time, they're only responsible for that daily accrued interest, or in some cases it's monthly accrued, that for the time that they've been holding the money. So a few examples that we can walk through here briefly just to illustrate how widely these programs span across different industries. So I won't go into too much detail on each one, but we had a company recently that sells medical devices. They're looking for $75,000 to hire short-term contractors. They have busy and less busy seasons, so they're looking to staff up during the busier part of the year. And with a great borrower profile, excellent FICO, an industry that is considered moderate to lower risk, they're eligible for one of the better rates that we have to offer, which is 10.25 with monthly payments. So second example, bit of a different use case. We've got a company that offers landscaping services, I believe commercial in this case, for large multifamily buildings and industrial offices and things like that. And so they're looking to bridge the gap of their invoices, right? So they are performing work that costs them money in labor and materials, but their customers may not be paying them back for whatever period of time, 18, 24, 30 days, something like that, right? So they're looking for a line of credit that they can tap into to bridge that gap before their customers actually pay them back. So this company was, I believe, only a year and a half in business, which resulted in a slightly higher interest rate of slightly over 12% and biweekly payments rather than monthly payments. So just for the biweekly example, if they had a 12-month term and you're trying to calculate their principal payments, rather than dividing by 12 months, you're actually going to be dividing by 24 because they're making 2 payments a month. So there's something to be aware of. So third example, food and beverage distribution. As you can see, this company likely had much higher revenues, given that they were qualifying for $225,000. They're able to secure an interest rate of 11% monthly payments, and their particular use case is purchasing inventory, which, as you can imagine, in that industry is going to be one of their primary costs. And finally, we had a point of sale technology company that's looking for an emergency fund. Essentially, they didn't have an immediate use case for this money, but they want to make sure that in the event of anything happens, some of their contracts slow down, perhaps some of their technology breaks and they need to replace it, they want to have that rainy day fund or emergency fund in their back pocket. So the company was doing about $1 million in revenue. We're able to qualify them for about 8.5% of that, which is $85,000 at an interest rate of 10.95%. And because I believe they had a little bit lower borrower FICO, I believe that was the case, then it's weekly payments in this case rather than biweekly and monthly. So I give all of these examples just to show you the wide variety of use cases and industry that these programs can span. So if you have any concerns about if your customer is a good fit for this, if their industry is a good fit, if the use case they have in mind makes sense, please reach out and we're happy to answer those questions. So with that, I'm going to pass it back to Cray now and let him continue discussing these products.
Awesome. Thank you, Thomas. So again, if you all have any questions about how these products work, reach out to me at any time. I look forward to providing those answers. But before we move into a Q&A here, I want to talk a little bit about, how this works as a partner of Loanspark. So there are a few marketing techniques that we've seen very effective with this type of product, and a few key indicators that you can look for to really capitalize on this product as a partner of Loanspark. One of those would be just, reaching out to your clients, or maybe in passing discussions, identifying if they have, kind of the following goals. Number one, if they need flexible access to capital, like we went into a moment ago, you don't have to take the full draw immediately with this type of product. You can actually, draw from it little by little, or draw from it as needed. So it makes it a very flexible and versatile type of capital, or access to capital. Also, fast turnaround. Lots of borrowers will come to banks, go to other financial institutions, but they can't get the capital that they need to make those critical purchases, or be able to fulfill those expenses that come up quickly. So if a fast turnaround is required, to come to Loanspark for a line of credit. If they have a short-term need for capital versus a long-term, line of credit may be a really great fit for them. We do have long-term forms of capital as well, but on the short-term basis, line of credit is pretty much unrivaled. If they have a revolving need for capital, so perhaps, they're a seasonal business, something comes up monthly, they're a trucking company, and sometimes there's, repairs that need to be needed ever so frequently, a revolving line of credit, or a short-term line of credit is going to be extremely critical to them being able to sustain and grow their business operations. And then ultimately, if they don't want to pay interest on unused capital. So if you have a customer come to you and they say, oh, should I do a loan or a line of credit? Well, it's going to come down to, whatever suits their needs the best. And a lot of times, a borrower doesn't necessarily need full access to that capital at once. They don't need that lump sum deposit, and therefore they shouldn't be paying interest on that full amount if they're not going to be utilizing it or investing it back into the business. So if it's a situation where maybe they just need a little bit of access to capital, or they need to keep it in their back pocket, lines of credit are going to be a great fit for your client in those scenarios. Finally, outside of just, keeping that dialogue open with your clients, there's also referrals that you can start to cultivate, right? You may do one deal with a client now. Maybe they have a friend or a family member in the future who needs access to capital. That's going to be a great way for you to kind of drum up business that way. And finally, online marketing. Lots of our partners are very active on Facebook, Instagram, Google, doing online advertisements, or maybe they're tapping into their network on LinkedIn, or perhaps they take a different approach and they're doing an email marketing campaign. All of those marketing methods are going to be highly effective. And if you target the right customers and you target the right products, you can really do very well. If you have questions about how to strategize your outreach methods or anything like that, reach out to me. I'm happy to connect on a one-on-one setting and provide some insight on what's worked effectively for our partners in the past. And then finally, why fund lines of credit with Loanspark? As you all know, many of you on this call have worked with us and closed deals with us in the past. We work very quickly. We have a very high, fast turnaround. And with lines of credit, we can get approvals as fast as same day, or as fast as same or next day. My apologies. And like Thomas mentioned earlier, they get access to an online portal where they basically have instant access to that capital. So typically we see approvals in less than 48 hours with this program. No depository relationship required with us. Many of the local banks or bigger financial institutions require that the applicants bank with them and deposit and move their checking account over. We're not going to require any of that from your customer. So that's a huge upside for someone who's not willing to take that jump and move banks, or they just, don't have the ability to do so. And then, of course, you can pick between many of our investors' offers with one application. A lot of times we take in an application, collect the documents, submit it to our investors, and your borrower may have a few different structures to pick from. They can that way kind of tailor the solution to their needs, their goals, and what works best for them. Your clients will stay your clients as a partner of Loanspark. So locks or lines of credit are a great gateway product into financing. What I mean by that is that many of the customers that come to us get a line of credit, come back to us in 3 months for another financing option, or they just stack a line of credit with another type of product, right? So an SBA loan and a line of credit, right? So you get that custom solution, and all of your clients that come to us stay your clients. Again, our programs are flexible. We don't just offer lines of credit. We wanted to highlight it before the end of the year because it's a highly effective and highly sought after product. But at the end of the day, we also offer equipment financing, term loans, lines of, real estate type financing. So our programs are vast, diverse, and highly effective. So we can be your one-stop shop on that front. And then, of course, you can combine multiple funding types. Like I mentioned a moment ago, you can stack a line of credit with another product to kind of mold that to your client's needs. And you have the flexibility as a partner of Loanspark to either refer deals over to us or to broker them if you want to take more control over the deal. Let's talk a little bit about the differences between brokering and referring, since I know it's a huge benefit with this partnership. So with a referred deal, you're essentially handing it off to Loanspark, right? You're able to focus on your bread and butter, meaning that you can pass it off to us and move on to your next deal, right? Or maybe you're a marketer. You can focus on your marketing strategy and let us fund the deals for you. And we'll be in control of, taking care of reaching out to the client. We'll make sure that we collect the documents. We'll make sure that we walk your clients through every next step in the process, help them understand their options. We basically do everything for you. With this type of scenario, you would make 20% commission on the first draw, and then we work with the applicant directly. Alternatively, you can broker deals with us where we would act as a direct lender. You'll be in charge of collecting the documents. You'll be in charge of presenting the offer to the customer and closing the sale, but you get a reward for that in the form of 50% commission. So much higher commission, but we're going to be working with you directly, and you're going to be working with the customer. So you'll be in charge of moving the deal forward and ultimately collecting everything and closing the sale. And if you have any questions after this call about, what the differences are or when you should use one versus the other, definitely reach out to me. I'm happy to dive a little bit deeper. So before we move into the Q&A session here at the end, if you did miss our previous webinars, again, you can just visit our YouTube channel. This year, we've posted a whole array of webinars, everything from equipment financing, short-term business loans, as well as I think 3 or 4 real estate geared webinars. So go to our YouTube channel if you have any questions or if you want to get up to speed on those types of webinars. I know Sasha posted that in the chat earlier. Outside of that, we'll see you in 2025 for additional trainings and webinars, and we look forward to seeing you all there.